Gold is still in a bull run, but the cracks are appearing. When you see a market that has been this strong start showing signs of resistance at every rally, you have to ask a serious question. Are these hairline cracks, or are they the beginning of something deeper? Right now, the lower time frame is painting a picture of buyers being pushed back. Every time buyers try to advance, sellers are forcing the ceiling lower and lower. In today's gold analysis, you will discover that the dream scenario of gold exploding higher in the coming months may be premature. Structural resistance is building with each successive push lower as sellers steadily reclaim lost ground. By the end of this analysis, you will understand the higher time frame market structure, the critical price zones, what volatility is telling us, and the three scenarios that will define which direction gold breaks from here. Welcome back. We are Bitcoin Capital Gold. A global financial reset is quietly unfolding. Governments and major institutions are positioning for a future where Bitcoin and gold replace the current fiat system. This channel focuses on just these two assets. That's what makes us Bitcoin and gold specialists. Using macro and structured technical analysis, we help Bitcoin and gold investors and traders make informed decisions. If this sounds like this information can help you, subscribe to this channel. It is critical to understand market structure because it reveals the path of least resistance by mapping price movements, trends, and the balance between buyers and sellers. Let's start with a high-level view across the higher time frames, because without this context, everything else we look at is just noise. Gold's all-time high was set on 29th January 2026 at $5,627. That remains the defining ceiling. On the yearly chart, the trend is strongly up with the swing direction also up. The last structural yearly swing low sits at $1,618 from 3rd November 2022. Until that level breaks, the yearly uptrend is structurally intact, and nothing in the current price action is threatening it. On the monthly chart, both the trend and swing direction remain up. The last monthly structural swing low was set on 14th November 2025 at $2,541. The monthly structure is holding. On the weekly chart, the picture is changing. The uptrend has been broken, and the trend is currently undecided, with the swing direction now down. Once the prior low was broken on 2nd February 2026, sellers were able to drive price to a new structural swing low at $4,100 on 23rd March 2026. That shift in the weekly swing structure is significant. It is the first meaningful crack in gold's higher time frame narrative. On the daily chart, the picture is clearer still. The trend is down and the swing direction is down. This is where the hairline cracks are becoming visible. A daily downtrend inside a monthly and yearly uptrend tells us this is a correction, but corrections can go further and last longer than anyone expects. The daily structure deserves respect. Understanding price action is essential because it tells us the story of supply and demand to make decisions based on real-time market sentiment rather than lagging indicators. All through February, gold's price action was defined by just 3 bars: 29th January, 30th January, and 2nd February. Those 3 bars established the dominant range: a high of $5,627 on 29th January and a dominant low of $4,422 on 2nd February. Everything up to that point defined the context of that structure. However, March has come along and broken that range, forming a new layer of information. Buyers pushed to a new monthly high of $5,434 on 2nd March, taking out February's buyers' stops in the process. But with 3 days of March still to close, the picture that is emerging is striking. February started from its monthly low and ended on its monthly high. March appears to be doing the exact opposite, starting with a monthly high and trading near its monthly lows. That reversal in monthly character is a signal that should not be dismissed. The daily swing structure makes the picture even clearer. A sequence of lower highs and lower lows has been forming, a textbook downtrend on the lower time frame. The highs tell the story. 2nd March, $5,434, 10th March, $5,248, 17th March, $5,049, 25th March, $4,601. Each high is lower than the last. The lows confirm it. 3rd March, $5,005, 16th March, $4,970, and the current structural swing low of $4,100 on 23rd March. The swings are getting deeper. Sellers are in control on this lower time frame. Inside a higher time frame uptrend, that is a correction. But as corrections go, this one is showing increasing conviction from the sellers. The monthly chart has produced an outside reversal bar in March, confirmed by 3 consecutive weeks of downward pressure. Where March closes in its final 3 days will be closely watched. The line in the sand is $4,000. We covered this level in detail in our previous gold analysis. You can watch that video using the link on screen or in the description. That level is not just a round number, it is structural. Fibonacci price zones in analyzing price charts gives us a huge advantage by creating a mathematical framework for understanding market psychology, human herd behavior, and natural market rhythms. The Fibonacci zones are building a layered picture of resistance that is compressing price from above. Starting at the top, the first Fibonacci resistance zone sits between $5,361 and $5,385, anchored by the March high. Below that, the next resistance zone sits between $4,856 and $4,863. The current resistance zone sits between $4,673 and $4,683. Each rally has been meeting resistance, and that resistance ceiling is getting lower. On the downside, the Fibonacci support zone sits between $4,208 and $4,229. Price is currently caught in a tight range of just $500, from $4,208 to $4,683. Something will break out of this range. The question is which direction. Volatility tells investors and traders about the speed and magnitude of price changes on any chart. It allows us to measure uncertainty, market sentiment, and direction. From the weekly perspective, ranges are typical, nothing unusual in isolation. But zoom out to the monthly, and the picture changes. March's range has already exceeded January's 2026 range, meaning volatility is expanding, not contracting. And it's the close to open that is giving us direction. After 5 consecutive up months, March is currently showing a down close to open of $867. Expanding ranges combined with a negative close to open is not a neutral signal. It's the market telling us that the energy behind this move is building, and for now, that energy is pointing down. Markets don't exist in isolation. By layering the macro backdrop adds context, so we understand how one or more markets could influence future price action. Crude oil is finding support around $80 and pushing back towards the psychological $100 level. It briefly exceeded that level on 10th March before retreating, and we are currently still trading below it. The US dollar index has found support at $99, and a break above $100 feels like a matter of when rather than if. Right now, demand is not flowing into equities, Bitcoin, or gold. It's building in the US dollar. That is directly relevant to gold's near-term direction. Equities are pushing lower. The Nasdaq has broken the 21st November 2025 low at $23,904 and has now produced a lower high and lower low, the start of a daily downtrend. Bitcoin is treading water between $60,000 and $76,000, and gold for now is holding above $4,000. That $4,000 level is the line for gold to hold. A break and close below it would represent structural damage to this gold bull run. The market that deserves the most attention right now, more than oil, more than equities, is Japan. Japanese 30-year bond yields are surging, and the yen is continuing to weaken against the US dollar. Japan is one of the largest holders of US treasuries in the world. If Japan begins selling those holdings in size, the implications for global bond markets, the dollar, and risk assets, including gold, would be significant. This is the market to watch. All of this could flip rapidly. A ceasefire announcement or a U.S. withdrawal from the conflict would change the macro picture quickly, and with it, the pressure on gold could reverse just as fast as it built. We have looked at market structure, price action and price zones, volatility, and correlated markets. Now we visualize how markets could play out. Scenario 1. Buyers push higher. The first zone buyers need to challenge and close above is $4,700. Beyond that, $4,900 and the upper resistance zone at $5,400. Each resistance zone needs to be cleared for any meaningful recovery to develop. Scenario 2. Range continues. Price is already compressed into a tight range of just $500. Further compression will only build more energy for the eventual break. The probability of that break being to the downside is higher given the current structure. A ceasefire is the most likely catalyst for a directional resolution. Scenario 3. Support fails. The line of least resistance is down. Sellers are building their case methodically, controlled so far, but with the capacity to accelerate quickly. A break and close below the Fibonacci support zone below $4,200 opens the door to challenge the structural low $4,000. We would then need to reassess the structural damage to this bull run. Let's bring this all together so we are clear on market structure, which price zones we should be focusing on, volatility, and how markets could play out this week. Gold's higher time frame uptrend is intact, yearly and monthly structure unchanged, but the weekly and daily are showing the first meaningful cracks. A sequence of lower highs and lower lows on the daily, a weekly swing direction that is turned down, and a monthly outside reversal bar. These are not signals to ignore. Volatility is expanding, and it is expanding to the downside. Price is compressed in a $500 range between $4,208 and $4,683. That range will break. The macro environment, dollar strength, Japanese bond market stress, equities under pressure, is not providing cover for gold right now. The 4,000 level is the structural line that must hold. If you found this video useful, consider liking and subscribing so you don't miss our next update. What do you think of the levels we gave? Do you agree? Do you have your own levels you're watching? We'd love you to share your thoughts. Comment below so we can all discuss. At the heart of the new global financial economy will be Bitcoin and gold. If you want to be ahead of the curve, follow this channel.